Hey, welcome to the exchange. So this is a 10-year Treasury chart. It's probably top of mind for most investors. This chart really drives, auto loan rates, mortgage rates, etc. But it's actually a chart I think is way more important than a 10-year Treasury chart. Let's take a look at it real fast. So this is a very complex chart though, but what this chart shows is a 10-year bond yield, constant maturity, basically the inflation index. So all that means is you take a 10-year bond yield minus out the expected inflation over the next 10 years or so, and you basically either get a positive yield or a negative yield here. So if you look at the chart right here, you basically have a 0% line in the middle. So anything above 0% basically saying, hey, the current bond yield at this given date was above the expected inflation yield itself. If it's below, like we were in 2020, 2021, and a little bit of 2022, basically saying, hey, the 10-year bond yield it's actually itself is below inflation expectations. We actually crossed from negative to positive in the roughly, looks like early May timeframe. We actually peaked out, looks like here, June 14th or June 15th. Basically just under 1% right there. We actually have tapered down quite a bit since June 15th and led to a small rally in the equity markets overall. Okay, great. So what's that really mean in the bigger picture overall? So I'm basically going to zoom out the time scale here, go to max time scale. What you notice here is this large rally we've had. Basically, this graph's shot up vertical almost since the March timeframe back to the mid-June timeframe. But notice each peak we have here, each spike we have here. Look at here, March 2020. Look at here, it looks like here, it looks like spring, early summer timeframe 2013. Another one in winter time to spring of 2011. Also September 2008 timeframe. All this really shows monetary conditions getting very, very tight, very, very fast, which either causes the Fed to pivot or number two, basically something breaks, something happens. Basically, have a financial crisis, a major firm fails or has major issues, people start complaining. I mean, it gets very, very bad, very, very fast. You notice here, looking at the scale we've had in the vertical spike, basically versus inflation, I mean, it's just been a rocket ship up. I mean, it's been a very long, sustained spike. And it's really what we're seeing in the kind of late June timeframe was kind of a relief rally in the equity market because this has shot up so high, so fast. It's just not, at least short-term wise, wasn't sustainable. Now, medium-term wise, as like this summer and this fall, it might go up again. I'll explain that more a little bit later. But again, this shows you when this actually spikes out, when it actually tops out for good, we should have a broad equity rally across the board as basically people shift away from bonds, if they're in bonds right now, back into equities overall across the entire market. So this is the 1 year view of that chart. So we can see here, June 14th was the local peak at 0.89%. It has been dropping since then. That's why we're really seeing an equity rally, really a rally off the floors we saw in mid-June timeframe. We're currently at 0.65%. Now, if I had to guess, the actual true peak of this chart for 2022 actually is still upcoming later half of this year. Now, really two reasons are going to drive that. So number one is quantitative tightening. So really the lack of buying in bonds is dropping demand overall. So when demand's very low, bond yields stay very, very high. And that's what we're going to see second half this year until the Fed actually truly pivots, which could happen later this fall timeframe. Number two is actually deflation. So we're seeing deflation all across the economy. Look at commodities, houses. We're going to see auto deflation later on this year. And really inflation expectations should drop off a cliff second half this year. So according to this chart, if bond yields stay pretty high and inflation drops off dramatically, this actual number could skyrocket well past 1% overall. So let's go back out to the max view and think of it like a stock in a way. So you have resistance levels at roughly 1.15, 1.17%. Another one in 2011 at 1.34%. So really, once it crosses, or if it crosses those points at all, I would say at that point it's probably a buying opportunity because they're really basically tightening so fast and so much. Where at that point, I think the Fed pivots likely very, very soon. So either A, something's going to break, or B, the economy go from basically a recession to basically a severe recession and or early depression overall kind of market. And the Fed does not want that in the long term, but that's going to kill overall growth and overall demand across the entire economy for all classes, etc. But looking at overall long-term average, long-term trends, we are trending down across this chart. You really see the average in the last 10 years. It's roughly around 0%. I think we're going to return to that point post this kind of supply chain crunch and hyperinflation fears and everything else too, and kind of recessionary fears too. I think the true actual trend, bond yield trend, and inflation trends should trend around 0%, basically according to this chart, but we'll see what happens in the future. Hey, but that's a very interesting chart in my opinion. It really could show that true Fed pivot coming soon, especially the faster we cross that 1% threshold, but we'll have to see if we cross that at all in 2022. But yeah, be sure to sub, like, comment down below. I'm also going to drop this chart down below as well too. But yeah, until next time, that's the exchange.